What if I told you that the biggest reason you're losing money isn't inflation, the stock market, or even your salary? It's your brain. Every single day, millions of people make terrible financial decisions without realizing it. They overspend, panic sell investments, ignore opportunities, and stay stuck financially. Not because they're unintelligent, but because of hidden psychological traps called behavioral biases. These mental shortcuts silently control how we spend, save, and invest money. And in 2026, with social media, AI-powered advertising, instant shopping apps, and financial hype everywhere, these biases are stronger than ever. Today, we're breaking down the 7 behavioral biases making you lose money every day and how to beat them before they destroy your financial future. Let's get into it. The first bias is confirmation bias. This happens when people only look for information that supports what they already believe. For example, imagine someone buys a risky cryptocurrency. Suddenly, they only watch YouTube videos predicting that coin will go to the moon. They ignore all warnings and negative analysis. Sound familiar? This bias traps investors in financial bubbles because they stop thinking objectively. In 2026, algorithms make this even worse. Social media platforms feed you content you already agree with, creating a financial echo chamber. The result? People double down on bad investments instead of admitting they might be wrong. Smart investors constantly challenge their own opinions. They actively search for information that proves them wrong. Because the goal isn't to feel correct. The goal is to make money. Humans hate losing money more than they enjoy gaining it. This is called loss aversion. Psychologists discovered that losing $100 feels emotionally stronger than gaining $100. That's why many people panic during market crashes. Instead of staying calm, they sell investments at the worst possible moment, because emotionally, avoiding pain feels more important than making rational decisions. Ironically, this often locks in losses permanently. The wealthiest investors understand something important. Temporary losses are normal. Markets go up and down. Emotional reactions are what destroy long-term wealth. If you constantly make decisions based on fear, your emotions will control your bank account. Have you ever noticed that when people make more money, they suddenly spend more money too? That's lifestyle inflation. Someone gets a raise, and instead of investing the extra income, they upgrade their car, apartment, clothes, and subscriptions. Before they know it, they're earning more, but still living paycheck to paycheck. In 2026, this problem is exploding because social media constantly pressures people to appear successful online. Luxury lifestyles are marketed 24/7. People buy expensive things not because they need them, but because they want social validation. True wealth isn't about looking rich. It's about having financial freedom and peace of mind. The people who quietly invest and live below their means often become wealthier than those trying to impress everyone. Humans naturally follow crowds. It's a survival instinct. But financially, herd mentality can be extremely dangerous. When everyone rushes into a trendy investment, many people assume it must be safe. This happened during meme stock crazes, crypto hype cycles, and even housing bubbles. People buy simply because everyone else is buying. Then when panic starts, the crowd runs for the exit at the same time, and late investors get crushed. Successful investors think independently. If everyone on social media suddenly guarantees easy money, that's usually a sign to slow down and think carefully. Remember, when emotions drive the crowd, logic disappears. Modern technology has trained people to expect instant rewards. One-click shopping, instant food delivery, instant entertainment, instant dopamine. Unfortunately, wealth doesn't work that way. Building financial freedom requires patience. But many people sabotage themselves because they choose short-term pleasure over long-term rewards. They spend money today instead of investing for tomorrow. This is called instant gratification bias, and companies are incredibly good at exploiting it. Apps, ads, and influencers constantly encourage impulsive spending because emotional consumers are profitable consumers. The solution? Delay purchases. Even waiting 24 hours before buying something can dramatically reduce unnecessary spending. Your future self will thank you. Most people believe they're smarter than average, especially with money. That's overconfidence bias. After making a few successful trades or investments, people start believing they can predict markets consistently. They take bigger risks, ignore warnings, use too much leverage. Then reality hits. Even professional investors struggle to consistently beat the market long term. Confidence is useful. Overconfidence is expensive. The smartest financial minds stay humble because markets are unpredictable. If someone online claims they have guaranteed investing strategies, be careful. Real investing is about risk management, not ego. The final bias is anchoring bias. This happens when people become emotionally attached to a specific number. For example, someone buys a stock at $100. The stock falls to $60, but they refuse to sell because they're mentally anchored to the original price. They keep thinking, I'll sell when it gets back to 100. But markets don't care what price you paid. Anchoring also affects shopping. If a product says originally $500, now $199, people suddenly think it's a great deal, even if the product isn't worth buying at all. Your brain uses the first number it sees as a reference point. Smart consumers and investors focus on actual value, not emotional attachment to numbers.